Hi there. This video deals with one very specific part of your consolidation, and that's right at the beginning, the proper calculation of goodwill. It's really discouraging if you start your consolidation problem with the wrong amount for goodwill. It messes up your balance sheet kind of forever. So I've got a way here for you to get the goodwill right the first time, and then if you use this method, you're going to start your consolidations properly. Just to let you know, I'm using IFRS accounting standards. That means the acquisitions method. Now, under IFRS, you can use the entity theory or the parent company extension theory. If you purchase 100% of the shares of this company, then both theories will give you the same amount for goodwill. And in this video, I'm using 100% ownership to get across how to calculate goodwill. So our easy example to start with is buying this subsidiary for $180,000. Remember, assets minus liabilities equals equity. So when we move to the balance sheet here, you'll see that the balance sheet at acquisition has assets of 206 less liabilities of 56 leaves 150 in equity. The only change I'm making to fair value is to increase inventory $20,000. So in terms of fair value, we have $226,000 of assets, $56,000 of liabilities, net fair value $170. What I recommend strongly is that you actually calculate your goodwill 2 times. Now this might seem like extra work, but it's actually really quick to do it the first way, and it gives you a check figure for the second calculation, which lets you move forward with some confidence. So let's do that by first calculating goodwill using fair value. So as noted on the previous slide, the fair value of your net assets is $170,000. You paid $180,000. So this actually makes sense, doesn't it? You paid $180,000 for $170,000 fair value of assets. Goodwill is $10,000. Now, the second calculation uses book values, and this is where you calculate an acquisition differential and allocate that acquisition differential to fair value increases or decreases, and then come up with goodwill again. The thing is, now you have a check figure and you will come up to the same number. So if we look at the balance sheet at acquisition, we can see that the assets are 206, liabilities are 56, leaving us 150 as the net book value. Note that this is the same number as shareholders' equity. Some questions you do will only give you common shares and retained earnings, but that number of 150, again, assets minus liabilities equals equity, is going to be the same number. So whether you are given this and calculate it, or you're just given this, you know what net book value is. So here's the second calculation. You paid $180,000, subtract book value of net assets, gives you a $30,000 acquisition differential. $20,000 of that is used up by an increase in inventory, leaving you goodwill of $10,000, which is the number we calculated before. Now, the second example is basically the same, except I've got a lot more changes to the fair value of assets and liabilities. So this allows us to use the same basic information but do a more complicated example. So notice in this example, accounts receivable goes down, both inventory and plant and equipment increase in value, but you also have a liability that increases in value, giving us $236 fair value of assets, $58,000 fair value of liabilities with a new number of 178 for net fair value. So again, let's calculate goodwill initially using fair values. We're at 178 for net fair value. You paid 180. So you can figure out goodwill here, right? What's goodwill? Well, you're right, $2,000. So this first method is quick, it's easy, and you get the right amount. Now we're going to do this by allocating the acquisition differential, and we'll come up to 2,000 again. As in the previous example, net book value is still $150,000. So we paid 180, we subtract net book value, we're left with an acquisition differential of 30,000. Now the way I like to do this, and a way you won't see it in every textbook, is to use debits and credits to keep straight whether you're going to end up subtracting or adding to this acquisition differential. So accounts receivable went from 10,000 to 8,000. That's a credit. Inventory and asset went up. That's a debit. Your plant and equipment, another asset, increased. That's a debit. Your bonds payable, a liability, increased. That's a credit. So what I do is put the debit or credit beside the number, and now I have 32,000 in debits, 4,000 in credits. That works out to a debit of 28,000. This means you received more than book value. That uses up your acquisition differential, leaving this goodwill of 2,000. That's the same number we had before. Now the third example is involving negative goodwill. So in this example, it's just one really specific case where we actually have what's called a bargain purchase. So in order to make this happen, I'm changing our purchase price from 180,000 to 150,000. Now, in the previous example, we had a fair value of 178,000. We just bought that for 150. So the difference, 28,000, is negative goodwill. Under IFRS, you can't book negative goodwill as a parent company. Instead, you recognize it immediately as a gain on purchase. So this is a gain, a credit for the parent company when they do their records. So notice that if you pay more than the fair value of net assets, you have goodwill. If you pay less than the fair value of net assets, you have negative goodwill, which is a gain. So let's once again, using these numbers, calculate goodwill using fair values. We paid 150,000. We received $178,000 net fair value. That means negative goodwill of 28,000. Doing it the long way around and allocating that, you'll see that we paid 150,000. The book value of net assets is still 150. And notice that our acquisition differential is 0. That does not mean you can stop here. You're not done. An acquisition differential can be positive, 0, or negative. And any of those numbers, whether positive or negative, can give you either a positive or negative goodwill. So you have to carry through the rest of the problem to calculate goodwill. But we are starting from 0. So as in the previous example, we have a credit to accounts receivable to decrease to fair value, 2 increases, your inventory in plant and equipment, and a credit to increase your liability account. This is still netting out to a debit of $28,000. Now remember what we did before. We took the acquisition differential and we subtracted $28,000. Well, we're going to do the same thing. 0 minus $28,000 is minus $28,000. That matches our check figure from before. It's the right number, and we can move along and do our consolidation. So, in summary, it's a good idea to do this two-step method, if only for your peace of mind, to go ahead with the consolidation question. Your acquisition differential can be anything. Don't think that a negative acquisition differential automatically means that you have negative goodwill. You have to go through the whole calculation to figure that out. And that's it. In the next video, we're going to look at less than 100% ownership and see how you handle that.